Most people invest in the stock market their entire adult lives without ever understanding how it actually works. They hear terms like the market is up, or stocks crashed today, and they just nod along, hoping for the best. But here's the thing, if you don't understand the machine you're trusting with your money, you're flying blind. In the next 14 minutes, I'm going to explain exactly how the stock market works, no jargon, no fluff, just a clear, simple breakdown that will permanently change how you think about investing. Let's start at the very beginning. A stock is simply a tiny piece of ownership in a company. When a company wants to raise money to grow, build new factories, hire more people, develop new products, instead of borrowing from a bank, it can sell small ownership slices to the public. Those slices are called shares, or stocks. When you buy a share of Apple, for example, you literally own a tiny fraction of Apple Incorporated. You're a shareholder. A partial owner. Now, the stock market is simply the place, the organized system, where buyers and sellers come together to trade those ownership slices. Think of it like a farmer's market. Vendors show up with products. Buyers show up with money. They negotiate prices and make deals. Except instead of tomatoes and bread, the products being traded are pieces of companies. In the United States, the two biggest stock markets are the New York Stock Exchange, the NYSE, and NASDAQ. The NYSE is the largest in the world by total value. NASDAQ is where most tech giants like Apple, Google, and Amazon are listed. Today, most of this trading doesn't happen on a physical floor, it happens electronically, in milliseconds, across servers and platforms. Here's a question most people never think to ask: who decides what a stock is worth? The answer is simple, and a little humbling: you do. Or rather, everyone does. Stock prices are set entirely by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. That's it. There's no committee, no algorithm deciding the right price. It's a constant, real-time auction. But what drives people to buy or sell in the first place? Lots of things. A company reports strong profits. Buyers flood in. Price goes up. A competitor releases a better product. Sellers panic. Price drops. The Federal Reserve raises interest rates. Broad selling across the market. Everything dips. A pandemic hits. Mass uncertainty. Prices collapse. This is why the stock market can feel chaotic, because it's essentially a real-time voting machine reflecting millions of people's collective opinions, emotions, and bets about the future. In the short term, prices are driven by sentiment and news. In the long term, they're driven by something far more reliable: earnings. The actual profits a company generates. That's why legendary investor Warren Buffett famously said the market is a voting machine in the short run, but a weighing machine in the long run. Short term, popularity. Long term, fundamentals. The stock market isn't just individual investors sitting at their computers. The ecosystem is much larger. Let's break down who is actually trading. Retail investors, that's you and me. Individuals buying stocks or ETFs through platforms like Fidelity, Schwab, or Robinhood. We're the smallest players by volume but the most numerous. Institutional investors, these are the giants. Pension funds, university endowments, insurance companies, and sovereign wealth funds. BlackRock alone manages over $10 trillion in assets. When institutions move, markets feel it. Hedge funds, private investment pools that use sophisticated, aggressive strategies. They can bet on stocks going up or down. They move fast and they move big. Market makers, these are firms whose job is to always be available to buy or sell a stock. They ensure liquidity, meaning you can always find someone to trade with. Without market makers, the market would grind to a halt. Algorithmic traders, today, more than 70% of US stock trading is done by algorithms. Computer programs executing trades in microseconds based on predetermined rules. This is why markets can move violently in seconds on news that hasn't even been fully read by a human yet. The key takeaway: you are competing, indirectly, with trillion-dollar institutions and lightning-fast algorithms. This is exactly why, for most investors, trying to pick individual winning stocks is a losing game. We'll come back to that. When someone says the market was up today, what are they actually referring to? They're referring to a stock market index. An index is simply a curated list of stocks that together represent a segment of the market. It's the scoreboard. The three you'll hear most often. The S&P 500 of the largest publicly traded US companies. This is the gold standard benchmark. When people say the market, they almost always mean the S&P 500. The Dow Jones Industrial Average, just 30 large US companies. It's the oldest and most quoted, but because it only covers 30 stocks, it's actually less representative than the S&P. The NASDAQ Composite, over 3,000 companies, heavily weighted toward technology. When tech booms, NASDAQ flies. When tech crashes, NASDAQ hurts. These indices don't just tell you how the market is doing, they are the market, for most practical purposes. And here's the most important thing I'll say in this video. Over the last 100 years, the S&P 500 has returned an average of about 10% per year, including crashes, recessions, wars, and pandemics. Every single time it has dropped, it has recovered and gone higher. That's the most powerful data point in investing. There are exactly two ways to make money from stocks. 2. That's it. Number 1, capital gains. You buy a stock at $50. It rises to $80. You sell. You made $30 per share. That profit, the gain from the price going up, is called a capital gain. Simple. But here's what most people miss: you only realize that gain when you sell. Until then, it's just a number on a screen. Unrealized. This matters because beginners often panic sell during downturns, locking in a loss that would have recovered if they'd simply waited. Number 2, dividends. Some companies, especially mature, stable ones, pay their shareholders a portion of their profits on a regular basis. This is called a dividend. If you own 100 shares of a company that pays a $2 annual dividend, you receive $200 a year just for holding the stock. Automatically. No selling required. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have paid and grown their dividends every year for decades. They're called dividend aristocrats. Now here's where it gets powerful. When you reinvest your dividends, use them to buy more shares, you trigger compound growth. Your returns start generating their own returns. Over 20 or 30 years, dividend reinvestment can represent more than half your total portfolio value. This is why the best investors don't just chase hot stocks, they build systems that pay them while they sleep. Here's something that surprises most new investors: the stock market crashing is not a bug. It's a feature. Markets move in cycles. Always have. Always will. Expansion: the economy is growing, companies are profitable, stocks rise. Optimism is high. Everyone feels like a genius investor. Peak: valuations get stretched. Prices rise faster than underlying earnings justify. This is where danger hides: it feels like the party will never end. Contraction: something triggers a pullback. Could be rising interest rates, an economic shock, a geopolitical event. Fear spreads. Selling accelerates. Prices drop. This is called a correction, a drop of 10% or more, or a bear market if it exceeds 20%. Trough: the bottom. Usually only visible in hindsight. This is the moment of maximum fear, and historically, the best time to be buying. Recovery: slowly, then rapidly, confidence returns. Prices climb. The cycle begins again. Since 1928, the S&P 500 has experienced 26 bear markets. Average decline: 36%. Average duration: 9.6 months. But every single one was followed by a bull market that erased the losses and set new highs. The lesson: market downturns are temporary. Wealth destruction is only permanent for those who sell at the bottom. The investors who build real wealth aren't the ones who predict crashes, they're the ones who stay invested through them. So now that you understand how the market works, what should you actually do with that knowledge? Here are 3 principles that separate wealth builders from wealth wishers. Principle 1. Time in the market beats timing the market. No one, not the smartest hedge fund managers, not the most sophisticated algorithms, consistently predicts market movements. Studies show that missing just the 10 best trading days in any given decade cuts your returns nearly in half. Those best days almost always happen during periods of maximum fear. If you're on the sidelines, you miss them. Principle 2. Diversification is your only free lunch. Don't concentrate your risk. Owning 500 companies through an S&P 500 index fund is infinitely safer than owning 5 individual stocks with better average returns. Spreading risk across assets, sectors, and geographies is the single most reliable risk reduction tool available. Principle 3. Cost is the enemy of return. Every dollar you pay in fees is a dollar that doesn't compound. A fund charging 1% annually versus 0.03% may seem trivial, but over 30 years on a $100,000 portfolio, that difference adds up to over $150,000 in lost wealth. Low-cost index funds consistently outperform the majority of actively managed funds over any 15-year period. The data on this is overwhelming. Understand the market. Respect the cycle. Keep costs low. Stay in. If this video gave you a clearer picture of how the market actually works, you're already ahead of most people who've been investing for years. But understanding the market is just step 1. In the next video, I'm breaking down the single most popular investment vehicle in the world, the S&P 500 Index, and showing you exactly why it's outperformed almost every active fund manager on the planet for the past 30 years. You'll want to see the data.